Hey everyone, Patrick Langhans here, Cross Country Mortgage. It's Money Tip Monday. Today we're going to give you some tips on answering a question I get all the time. Should I pay down my mortgage aggressively, or should I take that money and put it into an investment like an IRA, 401k, savings account, something like that? So pay down the principal balance quickly, or take that same money and invest it. That's what we're going to help you answer today. Before I get into some of those tips, I do want to share I am doing a webinar for first-time home buyers on November 6th, 5:30 p.m. It's only an hour. Please share with a friend you know who's renting or considering buying their first home. If they come to the class, we will teach them everything they need to know, the process, the special programs they qualify for, down payment assistance, how to buy a home for $1,000, but most importantly, why real estate is the first step towards building long-term wealth. So we're going to be talking about the return on an investment when you own your primary residence versus renting and paying the landlord's mortgage. So share with a friend, have them come, great educational class, and we'll try and make it fun as well. All right, let's get into the tips on whether you should pay down your principal balance on your mortgage aggressively or take that money and invest it. There's a few things to consider. So the first thing to consider is liquidity. So what that means is when you pay down extra towards your mortgage, it's kind of like putting it in a savings account. You're reducing the balance on your mortgage, which increases how much equity you have. The thing is, once you pay down that balance, it's really hard to get that money back. So it's not like taking an extra $300 a month and putting it in a savings account, because you can get that money anytime you need it. When you put it towards your mortgage, it's harder to get it back. The only way to get that money back is to sell your home, right? Because you sell it, pay off the mortgage, you get the difference. Refinance, so you could do a cash out refinance, but that involves closing costs. It may change your interest rate. Or the third way is to do like a home equity line of credit or a second mortgage. So what you got to consider is liquidity. When you put it in, it's hard to get back when you pay down your mortgage. Now, if you have an emergency fund, if you have a big 401k balance, if your retirement account is good and well funded, you don't have other short-term debt that's eating into your monthly savings like credit cards, that kind of stuff, then you're probably okay to pay down that mortgage. If you have credit card debt, short-term debt, you don't have an emergency fund, you're not maxing out your 401k, then I would probably put that extra money towards those things as opposed to paying down my mortgage. Cool. Second thing, your age. If you are 50 years old, that's a great time to start paying down your mortgage, because you probably want to retire someday, hopefully in your 60s, maybe sooner. But 50, when I talk to financial planners, they say 50 years old is a great time to start paying extra towards your mortgage, because if you can aggressively pay that off and not have a mortgage payment when you retire, it makes it much easier to live on a fixed income. So 50 is kind of like a great age to start aggressively paying it down. Before that, you're probably not even going to be in that mortgage for the rest of your life, because you're probably moving, buying bigger houses, that kind of thing. So maybe you take that money and keep working on building up your retirement accounts if you're under 50. Next thing to consider is your interest rate. So if your rate's 2%, maybe even if you're 50, you're not aggressively paying that off, because that's almost like free money. So if your rate's 2% and you can earn 7% in the stock market, why would you pay off your 2% loan and miss out on the 7% return on investment in your IRA, 401k, or other investments? Now, if your rate's 7% on your mortgage, that may make a little bit more sense to pay down. There's some great calculators online where you can punch in your interest rate, your loan balance, and return on investment in the market, and it'll actually calculate that for you. So do a little Google search and check that out. Last thing to consider is how long will you be in your home? If you know you're in your starter home and you're probably going to move again, probably doesn't make sense to try and pay down your mortgage, because your monthly payment's not going to change, and you're probably not going to pay it off before you move again. So take that money, invest it in your 401k, IRA, stock market, may be a better decision. Now, if you're in your dream home and you know you're never going to move again, hey, that makes sense, because when you pay that off, now you don't have a mortgage payment or a housing payment for the rest of your life. If you want to use a really cool calculator, check out my link below to sign up for HomeBot. HomeBot is a great app where you can plug in your property address, your mortgage, your interest rate, And there's a little calculator in there that will tell you if you put $100, $200, $300 extra towards your mortgage, when you will pay it off. So really cool tool there. It'll help you determine your home value. So feel free to sign up for that. And if you have any questions for me, let me know. Also, don't forget about that first-time homebuyer class. Please share with a friend. Thanks.